Remember the 90s? You could grab a movie ticket for just a few bucks, fast forward to today, and that same ticket can easily set you back 15, maybe $20. The movie is the same, but your money has definitely changed. You hear it all the time from officials and the news. Inflation is hovering around our 2% target, but does it really feel that way when you're buying groceries, paying rent, or filling up your car? Do the numbers you hear on TV match the reality of your bank account? For most of us, the answer is a hard no. And that gap between the official story and your reality is the biggest, quietest threat to your wealth. In this video, we're going to pull back the curtain on why that official inflation number is, at best, misleading. We'll show you how much purchasing power you're really losing, and most importantly, give you a clear step-by-step plan to not just protect your wealth but actually grow it in this new reality. Section 1: The Great Inflation Lie. So, let's get right to it. Where does that 2% number even come from? It's calculated using something called the Consumer Price Index, or CPI. Think of it as a giant shopping cart that the government fills with a mix of goods and services each month to see how the total price changes. This basket has everything from apples and gasoline to haircuts and computers. The latest numbers from June 2025 show the annual inflation rate is at 2.7%, which is already well above that 2% target. The core inflation number, which is supposed to give a clearer trend by removing volatile food and energy prices, is even higher at 2.9%. And some economists are forecasting that both numbers could climb above 3% by the end of 2025. But here's the part they don't exactly broadcast. The government constantly tweaks what's in that basket. If the price of steak gets too high, they might lower its importance and give more weight to chicken, arguing that's how people naturally shop. It's a method called substitution. While there's a certain logic to it, it also conveniently helps keep the official inflation number lower. Then there's the biggest item for most people: housing. For homeowners, the CPI doesn't track home prices. Instead, it uses something called Owner's Equivalent Rent Power. This is a survey that asks homeowners a hypothetical question. If someone were to rent your home, how much could you get for it? It's an opinion, not a reflection of the actual skyrocketing costs of buying a home or paying for its upkeep. While the overall shelter index has still risen about 3.8% over the last year, that can feel painfully low to anyone trying to buy a house or seeing their property taxes jump. Why would the numbers be presented this way? Well, lower official inflation means smaller cost of living adjustments for Social Security and other government benefits. It helps prevent public panic and makes economic policies appear more successful. The story is comforting, but the reality is chipping away at your wallet. Section 2: The Silent Thief in Your Bank Account. This gap between the official numbers and your real life is what makes inflation a silent thief. It's not a big, loud event like a stock market crash. It's a slow, steady drain on your money. Let's break down what this really means for you, the biggest victim. Your savings. Let's say inflation is actually running at 3%. That 10,000 you have got in a savings account today will only have the buying power of about 7,400 in 10 years. That's a quarter of its value, just gone, without you touching a cent. It's like a slow leak in your financial bucket. You're purchasing power just dripping away, day after day. And what about your paycheck? So many people feel like they're running on a treadmill, and this is why you might get a 2% or 3% raise at work and feel like you're remaking progress. But if the real cost of your life, your food, insurance, kids' sports is going up by 5% or 6%, you didn't get a raise, you got a pay cut. Your income went up, but what you can do with it went down. This is why so many of us feel like we're working harder but falling further behind. We see this playing out everywhere. People are trading down, picking store brands over name brands, buying smaller packages, and delaying big purchases. Research shows a majority of consumers are now carefully researching products for long-term value instead of making impulse buys. It's a defense mechanism. Have you found yourself doing this? Thinking twice about something you wouldn't have blinked at a few years ago? That's not you being cheap. That's you reacting to your money slowly losing its power. This is most dangerous for your future. The money you're putting away for retirement has to last for decades. A steady 3% inflation rate can cut your nest egg's value in half in about 24 years. The safe number you planned for might be completely worthless by the time you actually retire, all because this silent thief was working against you year after year. This is a huge problem, and it's easy to feel overwhelmed, but just understanding the real game is the first step to winning it. If you're ready to stop playing defense and start building a real financial strategy, do me a favor and subscribe. We're focused on giving you the tools to fight back. Now, let's get into exactly how to do that. Section 3. Your 5-point inflation proofing plan. So, what can you actually do? How do you fight back against this quiet erosion of your wealth? It's not about panic, it's about being smart and strategic. Here's your 5-point plan. First, rethink what saving actually means. We were all taught to stash our money in a savings account. It was safe, simple, secure. Today, in many cases, that's a guaranteed way to lose purchasing power. While the national average interest rate for savings accounts is low, some high yield savings accounts are offering attractive rates of 4% or even 5% right now. These are great for your emergency fund, beating the current 2.7% inflation rate. But be careful, these high rates are temporary, tied to the Fed's current policies, and will likely come down. A high yield account is an essential short term tool, not a long term wealth building strategy. Second, become an owner, not just a saver. This is the most important mindset shift. You can't just save your way to wealth in an inflationary world. You have to invest. You have to own assets that grow faster than prices do. Historically, one of the best ways to do this is by owning stocks. When you own stock, you own a piece of a business. What do businesses do when their costs go up? They raise prices. As an owner, you get to participate in that growth. You're no longer just the consumer paying more. You're the owner who benefits from it. Third, invest in real stuff beyond stocks. Consider owning tangible assets, things that have real intrinsic value. The classic example is real estate. When inflation drives up costs, property values and rents tend to rise with it, creating a natural hedge. If buying a whole property isn't for you, you can look into real estate investment trusts or REITs, which are companies that own portfolios of properties. Another category is commodities. This includes things like energy and agriculture, but the most famous inflation hedge is gold. Gold is often seen as a safe haven when currencies lose their value. It's not about going all in on these, but about diversifying so that a piece of your wealth is tied to something physically real. Fourth, use the government's own tools against it. The US Treasury actually offers investments specifically designed to protect you from the inflation it measures. The two main ones are Treasury Inflation Protected Securities (TIPS) and I-bonds. The principal value of TIPS adjusts upward with inflation, so your investment keeps pace with the cost of living. I-bonds pay a mix of a fixed rate and a rate that changes with inflation. Since they're both backed by the US government, they are very low risk options for the more conservative part of your portfolio. Fifth and finally, master your cash flow and your debt. In an inflationary environment, not all debt is bad. High interest, variable rate debt, like from a credit card, is a financial disaster. As rates go up, the cost of that debt explodes. Paying it down needs to be your top priority. On the flip side, long-term, fixed-rate debt like a 30-year mortgage can actually work in your favor. You're paying that loan back over many years with dollars that are becoming less valuable over time. At the same time, you have to be more intentional with your spending than ever. Budgeting isn't about being restrictive. It's about being purposeful and making sure you have money left over to invest in your future. The official inflation numbers don't paint the whole picture. The inflation that hits your wallet and affects your future is almost always higher, and it's constantly draining the value of your money. But you are not powerless. By understanding what's really happening, rethinking what a safe investment is, becoming an owner of stocks and real assets, using the government's own inflation protected bonds, and mastering your debt and cash flow, you can build a financial fortress. The goal isn't just to survive inflation, it is to build a strategy that lets you thrive because of it. You can take control. If this video gave you a new way to think about your money, hit that like button and subscribe for more content that puts you in the driver's seat, and let me know in the comments What is the one price increase that has shocked you the most lately? I read every single one. Thanks for watching.